Assalamualaikum warahmatullahi wabarakatuh. My name is Meor Aizat bin Alias with the metric number 1819097 from Industrial Economic Classes SEM 1 2021-2022 Section 1. Would like to present on my topics, which is cross-border merger in banking sector. What is cross-border merger? Cross-border merger is a term that are used for two companies, Company A and Company B, located in two different countries, merged together. This company can be a form of private, public or state-owned company, and as a result, control and authority will be transferred to the merger or the acquisite company. The assets and liabilities of two companies are now combined into one legal entity. In Malaysia, cross-border merger and acquisition in the banking sector start as early as 1932 when Ho Ho Bank, the Chinese Commercial Bank, and the Overseas Chinese Bank to form Overseas Chinese Banking Corporation, also known as OCBC today. This was followed by Hong Kong and Shanghai Bank acquisition on the Mercantile Bank, while Chartered Bank acquired Eastern Bank in 1960s. In addition, in the 1990s, United Asian Bank was taken over by the Bank of Commerce. Later, this bank merged with Bank Putra Commerce on 1 October 1999. Eventually, many cross-border mergers before the 1990s were failed due to the economic recession. The behavior of the shareholder of the banking sector also act on their private interests, hinder the merge between the banking sector. Hence, much economic crisis leads to the solvency of commercial banks and finance companies. Although Bank Negara had implemented a rescue scheme, the number of active commercial banks in Malaysia was reduced to 34 in 1997, and the financial crisis in 1997 until 1998 hit Malaysia's commercial bank again showed the vulnerability in Malaysia's financial sector. And as a result, on 29 July in 1997, the government of Bank Negara Malaysia had announced a merger program for domestic banking institutions. This plan also include cross-border merger in banking sector. As we learn more about cross-border merger in the banking sector, especially in Malaysia, many causes lead to the merger bank sector. And the first one in the factor of the diversification. It is essential to meet customer demand in the growing international market. Hence, bank can provide better service for international customers and provide services to foreign markets. Secondly, was to increase the bank efficiency. This method may increase the economic integration between countries, allowing the exchange of expertise and policies to gain better profitability. And the third one is on cost efficiency. Having two banks merged together will eventually lower the average cost and help the bank to achieve the economies of scale in long term. Lastly, cross-border merger is really important to ensure the survivability of the banking sector. As the market pressure is increasing day by day, it is essential for the bank to not fall behind due to the international competitions. Hence, the cross-border merger in the banking sector will enhance the national trade and foreign investment. In the case of Malaysia, cross-border merger are really important as financial crisis in 1997 had caused a massive impact on Malaysian economics. There are few steps outlined by Bank Negara Malaysia (BNM) in the merger and acquisition process according to the press release in 2000. It focused on the structure, risk minimization, cost reduction, and the minimum threshold for shareholder funds and assets. This also applies for a domestic bank merger. In the end, it's proven that cross-border merger really helps to improve financial and economic stability, especially in the case of Malaysia. And as for now, we can see foreign bank participation accounting to 19.1% of the total domestic bank as in 2017. With the thriving of the banks such as HSBC, OCBC, and Standard Chartered, and UOB Bank. I think that's all from me. Thank you.